The stock market should have crashed by now. Consumer confidence is at financial crisis levels. Yet the S&P 500 keeps hitting record highs. What I'm about to show you explains this impossible contradiction and reveals the one economic pattern that institutions are quietly positioning for right now. Two surveys just flashed a signal that's never appeared in modern history, and almost nobody is talking about it. The first measures how people feel about the stock market. It's currently at one of the highest readings in 30 years, higher than the dot-com bubble, higher than the peak before the financial crisis. People are euphoric about stocks. The second survey measures how people feel about their own economic future, and here's where it gets disturbing. That reading is sitting at great financial crisis levels, the same despair we saw in 2008 when unemployment was spiking and the banking system was collapsing. Let me say that again. Stock market confidence at 30-year highs, personal economic confidence at crisis lows, at the same time. This has never happened before. Not in the 80s, not during the tech crash, not during the housing bubble. Never. You're watching two economic realities exist simultaneously. One where assets soar endlessly, another where regular people can't afford groceries. Most analysts dismiss this as noise. Consumer sentiment always lags, they say. But what they don't want you to know is that this divergence is a symptom of something breaking deep in the financial system. Something that's been building for decades, and the reset required to fix it will be violent. Force number 1, the income robbery. Let me show you what's really been happening while everyone was distracted. From the 1960s to 2008, American incomes followed a steady upward path. 2.8% growth every year after inflation. For 50 years, you could plan your financial future with confidence. Then 2008 hit. And here's what they're not telling you. Since the crisis, income growth hasn't just slowed, it's systematically fallen behind the trajectory that held for half a century. Think about someone in 1999 planning for retirement. Based on 50 years of data, they expected a certain income by 2019. They budgeted, they saved, they planned. That income never came. For 15 straight years, Americans have been earning less than the pattern promised. But here's the real gut punch. That gap didn't stabilize, it widened. After the pandemic, income fell behind again. From 2019 to 2024, real personal income grew an average of 0.7% per year. Americans have been financially betrayed twice in 15 years. First, in 2008, then again in 2020. Now here's where it all clicks into place. While real income climbed 50% since 2010, the stock market surged 300%. A 6-to-1 ratio. For every dollar your paycheck grew, stock values grew 6. And here's what most people miss. This creates a psychological trap. Every year, you earn less than you expected. Every year, the market climbs higher than anyone predicted. So what do? You stay in stocks because it's the only game in town, even as your personal finances crumble. This explains the impossible contradiction. People feel hopeless about their future, but euphoric about stocks. Because stocks are the only wealth-building mechanism left. This is how you get a population betting everything on assets they can barely afford while drowning in debt. But that's only the first force. The second one is even more disturbing. Force number 2, the shareholder heist. Here's what's hiding in plain sight. American savings rates have collapsed from 13% to 4% since the 80s. At the exact same time, corporate profit margins hit record highs. These aren't two separate trends. This is a direct transfer. And here's where it gets interesting. Those corporate profits flow to shareholders. But unlike wage earners who spend on rent and groceries, shareholders reinvest. Where? Right back into stocks, gold, Bitcoin, real estate. This creates a compounding machine that accelerates wealth concentration. Watch how the cycle feeds itself. Higher profits generate bigger payouts. Those funds flow into assets. Prices rise. Shareholders grow wealthier. They buy more assets. Prices climb higher. Repeat. Now here's the devastating part. This cycle destroys housing affordability. For 60 years, homes cost about 4 times annual income. Today, 7 times. Housing became twice as unaffordable in just 25 years. Think about what that means for a regular family. Shelter is the biggest piece of the inflation calculation. When housing eats up more of your paycheck, you have nothing left to save. Nothing left to invest. You're locked out of the wealth-building assets that keep compounding for people who already own them. So the wealthy buy housing as an investment. Prices rise. Regular people can't afford homes. They rent. Rents rise. Inflation goes up. Wages buy even less. Meanwhile, the shareholder class sees their wealth double every few years. Corporate profits get reinvested. The machine accelerates. The result? Wealth inequality just hit 1920s levels. The top 0.1% own more wealth than at any point since right before the Great Depression. And here's what you'll never hear on CNBC. In 2000, 75% of Americans believed they could improve their standard of living. Today, 25%. 3/4 of the country no longer believe in economic advancement. That's not a statistic. That's a society coming apart. This is why people feel desperate about their future but manic about stocks. The market is the only ladder left, and everyone's fighting to stay on it. This gap cannot hold. History proves it. And listen, this isn't about doom and gloom. It's about pattern recognition. It's about being prepared. The 1929 Blueprint. What we're seeing today is an exact replay of 1929, and institutions already know how this ends. Wealth inequality peaked in 29. The stock market peaked at the same moment. Then the crash came. Between 29 and 1940, wealth concentration reversed completely. But that reversal didn't just happen. A catalyst forced it. Here's what almost nobody talks about. In the 1910s, the corporate tax rate was 0. Policymakers then pushed it to 40%. This change was economically brutal. Profits collapsed, asset prices crashed, unemployment spiked, but it reversed decades of wealth concentration. What followed? The most prosperous period for average Americans in history. The 40s through the 70s, strong middle class, achievable home ownership. The American dream actually worked. Then the 80s arrived. Corporate taxes started dropping. The economy boomed. Between 82 and 99, the market delivered 20% annual returns. But behind the scenes, inequality reversed and started climbing again. Today, corporate taxes sit at 21%, the lowest since the 30s, and inequality sits at the highest level since the 30s. This isn't random, it's the same pattern running in reverse. The 3 phases. Here's exactly how this unfolds. We are in phase 1 right now. Corporate margins stay elevated. Asset prices keep climbing. No policy shift yet. Money floods into stocks, gold, crypto. This phase can last months or years, but it always ends. Phase 2 starts when policy signals emerge. Watch for political momentum around taxing corporations or wealth redistribution. Here's the critical detail institutions understand. The market typically peaks before policy actually changes. In 29, stocks topped 1 to 2 years before taxes were raised in 31. The market discounts the future. Phase 3 is the reset. Asset prices either crash violently or stagnate for a decade. Either way, the divergence closes. The gap between financial wealth and real income collapses. Not if, when. Here's what to remember. The reset isn't cancelled, it's queued. Right now, quality assets are where the smart money sits. Companies generating real cash flow. Gold as portfolio insurance. Even crypto for risk-tolerant investors. These assets are catching massive inflows as capital floods into anything that compounds wealth. But you need 3 tripwires. First, policy shift signals. Any momentum on corporate tax hikes or wealth taxes, that's your early warning. Second, market breadth collapsing. When 5 stocks drive the entire market higher, that's dangerous. Third, credit stress. Consumer loan defaults, auto loan delinquencies, credit cards maxing out. These cracks appear before the foundation crumbles. Right now, we don't have policy shift signals, but the top 10 stocks, including the Magnificent Seven, have driven more than 60% of the gains in the S&P 500 in recent years. So market breadth is narrowing. Credit stress? Auto loan delinquencies are on the rise, with subprime delinquencies doubling since 2021, and household debt hit a record high in the third quarter of 2025. So we are potentially seeing the beginning of some of those signals. When those three signals converge, defensive positioning becomes survival. Cash, treasuries, dividend aristocrats, defensive sectors that don't crater in downturns. Here's your economic reset to-do list. If you're under 40, attack high-interest debt. Build a 3 to 6 month emergency fund. Max out, or at least consistently fund, your retirement accounts. If you're 40 to 60, check your allocation. If you're overly concentrated in one sector, stock, or country, diversify. Decide in advance what panic selling looks like for you and avoid it. Keep pushing hard on tax-advantaged retirement contributions while you still have peak earning years. The institutions see this pattern. They're positioning quietly, but you're getting the same information they have. Most people will get caught holding the bag when sentiment flips. You don't have to be one of them. For now, the crowd is staying in stocks, gold, and crypto, but when those tripwires you just learned about start triggering, be ready to move fast toward the plan you already designed. Because in Phase 3, speed is everything. The reset is coming. The only real question is whether you'll be ready when it arrives. Do one thing today to prepare for the reset. Open your portfolio, decide whether you're tilted more toward growth or defense, and, if it makes sense for your situation, start rebalancing toward the mix you actually want. If you found this valuable, hit subscribe. We publish fresh content several times a week to help you understand the economy and protect and grow your wealth, and keep the momentum going. Watch Why the Stock Market Hasn't Crashed Yet. What they don't want you to know. It's on the screen. If you want to get your financial house in order, I've put some links in the description that may help. Check it out. Thanks for watching. See you on the next one.